Chapter 11: Expenses incurred in business and profit-oriented activities. Part 1. In determining taxable income, normally the cost of living, which is comprised of personal expenses, are not deductible except in certain limited circumstances where, just by the grace of Congress, tax law allows a limited deduction. An example of that would be the mortgage interest, which is a payment, an expense that we incur in our personal lives for our home, and yet we get a deduction. And personal taxes that we pay, medical expenses, and so forth. The cost of making a living, the costs that are incurred in the process of a business or investment activity, those are mostly fully deductible, except in some limited circumstances where they're disallowed. These expenses are either allowed to offset business income under Section 162, or they're allowed to offset investment income under Section 212. There is a code, Section 262, that forbids deduction of any personal, living, or family expenses except as otherwise expressly provided in the code. But most professionals would agree that it's not really clear why we need such a code section, because it seems like it's obvious that no deduction is allowable in any circumstance except what the code provides. And those are situations like Section 162, 212, and other code sections that allow a deduction against income. So to say that personal living expenses are not deductible is kind of redundant, yet it's clear in the code. There's Section 262 that makes that clear. In addition to deductions in determining taxable income, Section 471 allows an offset for cost of goods sold in determining gross income. So that's the difference between a deduction and a cost of goods sold under Section 471, because a cost of goods sold is offset against the gross receipts of a business, the income of a business, to arrive at gross income, whereas the expenses of a business are deducted from gross income. And just because an item is a business expense does not mean that it's always going to be deductible. Although Section 162 may make an allowance for deducting an expenditure, it's not going to be allowed as a full deduction if it's a capital expenditure and it's an item that by its nature extends beyond the useful life of a tax year. So under Section 167, 168, or 197, an allowance is made for taking a portion of this cost and amortizing or depreciating it over its useful life. There's a difference between deduction for expenses and deductions for losses. Expenses are deductible under Section 162, whereas losses are deductible under Section 165. The distinction is important because each one has its own set of limitations and may be different than the other. And then we have a lot of limitation code sections that, even for expenses that would otherwise be allowable under Section 162 or Section 212, they are disallowed. An example is Section 183, which disallows expenses incurred in a hobby, except up to the amount of the income that is generated by that hobby activity. So as we see on the slide, Section 162 allows a deduction for all ordinary and necessary expenses paid or incurred in carrying on any trade or business. The terms trade or business are not defined in the code. So once again, we must look to judicial history and judicial definitions to determine whether an activity is in fact a trade or business. In Deputy versus DuPont, the Supreme Court has held that a trade or business is an activity of holding oneself out to others as engaged in the selling of goods and services. Other court cases, like Grotzinger, have maintained that just simply being an activity of selling something, a business or a product or service, is not necessarily a business activity. It must be continuous. In other words, in the words of Grotzinger, to be engaged in a trade or business, the taxpayer must be involved in the activity with continuity and regularity, and the taxpayer's primary purpose for engaging in the activity must be for income or profit. So the issue in Grotzinger was whether the taxpayer's gambling was a business activity or a hobby, and it turned out in that case that under the particular facts of the case, it was a business. However, keep in mind that in Grotzinger, the taxpayer had quit his full-time job and dedicated his time to a specific gambling activity, dog races. And as part of that activity, he had made it his business to learn about the ins and outs of the business, the track record of the competitors, and he had kept very good business-like records. In other words, he was making a living out of his gambling activities. And that was the deciding factor. It has been ruled also by the court, by the Supreme Court in Higgins versus Commissioner, that management of one's securities, management of an investment portfolio, is not a business activity, even if it's on a large enough scale to require an office and staff, and is the main activity of the taxpayer. It is simply an investment activity and is subject to Section 212, not Section 162. Once we determine an expense is deductible, it is important to distinguish whether it's deductible under Section 162 or Section 212, because the tax treatment may be different in the two circumstances. Trade or business expenses under Section 62 always go into determination of AGI. In the case of an individual, this is not as crystal clear as it is for a corporation. In a corporation, you will see on the top part of the Form 1120, the taxpayer's gross receipts minus all of the returns and allowances, plus all the other types of income such as interest, dividends, rent, and so forth. And then you get a gross income number. And the gross receipts are offset by the cost of goods sold, so that you have the profit margin as part of the taxpayer's gross income. And then from that comes off the deductions. In the case of an individual, the taxpayer's gross income, cost of goods sold, and the business expenses are all netted off against each other on a Schedule C, and the bottom line comes to the front of the return and is shown as part of the AGI. Yet, if you were to determine, for various purposes, an individual's gross income, total gross income, because there are some tests that use gross income and not the adjusted gross income as their measuring criteria. To determine an individual's gross income, you would take that individual's trade or business income offset by the business cost of goods sold. So the business deductions have no part in determination of gross income, but they are deducted to arrive at the determination of adjusted gross income. Deductions that are allowed under Section 212 for investments can either go into the determination of adjusted gross income. An example of that would be rental expenses that offset rental income on Schedule E, or they are miscellaneous itemized deductions such as investment expenses that go into Schedule A, and they're subject to the 2% of AGI floor, and they're added back as a preference item for the alternative minimum tax computation purposes. So as you can see, there's an incentive for any taxpayer to treat a particular deduction under Section 162 if possible, as opposed to 212, because 212 may not be as advantageous a deduction. Once again, there's a lot of judicial authority on this area that we must look to when you have a doubt between whether a particular item is a Section 162 or 212 deduction. In Gill versus the Commissioner, the tax court said determination of whether Section 162 or Section 212 applies turns on the origin and character of the claim giving rise to the expense, and whether it bears a sufficient nexus to the taxpayer's business. So in other words, did the activity that gave rise to the cost, to the expenditure, and the deduction arise out of the taxpayer's business or out of the taxpayer's investment activities, or for that matter, did it arise out of taxpayer's personal activities that were neither business or investment. Both sections 162 and 212 interact with many other code sections. For example, an item may be a business expense under Section 162, but it may also be interest, subject to Section 163, which has its own rules, or Section 164, which relates to the deduction of taxes. So an item of expense may be subject to both, more than one code provision. Most of the time, this would be a favorable thing for the taxpayer, because if you have an item that doesn't qualify, for instance, under Section 162, it may qualify under Section 163 as deductible interest. Same thing with taxes. The taxes may not be a business expense in the Section 162 deduction, but they may be deductible instead under Section 164. And the same thing with business bad debts and so forth. Most of the time, this plays in the taxpayer's favor. In some circumstances, the other code section that interacts completely circumvents Section 162 or limits the deduction under Section 162, even if it was allowable. For instance, charitable contributions are completely subject to Section 170 rules and its limitations. Even if they're incurred as part of a trade or business, Section 162 does not apply to them, specifically as a result of subsection 162B that is in the code, in Section 162 itself. Both Sections 162 and 212 allow a deduction for expenses that are incurred in the conduct of a taxpayer's trade or business or investment activities. Both sections, it's implied that the deduction is only available to the taxpayer for expenses incurred in his or her own activities, business activities or investment activities. In other words, a taxpayer is not allowed to take a deduction for an expense that it incurs for someone else's business or for the sake of another person. Therefore, we see that in Deputy versus DuPont, the Supreme Court disallowed the expenses of a corporation that the shareholder paid on behalf of the corporation, because the proximity of the expenses resulted not from the taxpayer's business, but from the business of the corporation. Now, if a taxpayer does in fact pay an amount and it's not for his own business, then what is that item and how do we treat it? That would depend on the nature of the payment. In the case of a corporation, is it a contribution to capital? In the case where a corporation pays the expenses of a shareholder, it may very well be that it's treated as a constructive dividend distribution to the shareholder, from which he then uses the funds to pay his own expenses. And in the case of individuals that are either related to each other or not related, when somehow one pays the business expenses of the other, it could be constructed as a gift. In the case where one taxpayer pays the expense of another with a sufficient business purpose for the taxpayer paying it affecting his own business, then those cases could be distinguished from the DuPont decision, and the taxpayer paying the expenses could in fact get the deduction. You see a couple of examples of that listed here on this slide. For example, the deduction allowed for payment by the parent corporation of the subsidiary corporation's warranty expenses because the quality of the subsidiary's services affected the parent's own business. So the parent had a business reason to pay the expenses, even though it wasn't its own expenses, it was somebody else's. You see a lot of this happening a lot of times where a corporation will pay the creditors of a supplier so that the supplier can stay in business and keep supplying the taxpayer with goods and services that it needs. In Conley versus the Commissioner, a deduction was allowed for payment of wholly owned corporation's debt to protect the taxpayer's business reputation. And my personal favorite is the case of a country music performer that was allowed a deduction for payment of the debts of an unsuccessful business venture that he promoted to investors who had bought it from him to preserve his own reputation. This is a case of Jenkin versus the Commissioner, a tax court case decided in 1983. It is known as the Conway-Twitty case. That was the stage name of the country music performer. Some of you might be familiar with this artist, or maybe even with the case. So for those of you who are, or even those of you who are not, I have produced a poem. This is tax poetry, so it may not be very romantic, but I'm sure that you'll find it humorous if you read it on your own. This is all in the handouts of this slide. Along the lines of what we just discussed, that a taxpayer normally does not get a deduction for paying the expenses of another, we need to look to employee business expenses when an employee pays expenses on behalf of the employer. These expenses would only be deductible if the employer is uh, the employer requires or expects the employee to incur them as a condition of employment. In other words, they have a sufficient nexus to the employee's business of being an employee. In this vein, the failure by the employer to reimburse by itself can be indicative that the expense was not required or expected. So unless the employer specifically has as terms of employment that the employee will incur certain expenses, such as drive around to customer sites to see them without reimbursement, then it could be said that the fact that the employer will not reimburse an item that the employee incurred on their own without any specific requirement from the employer could be indicative that the item was not required to be made in the first place and therefore is not deductible. Where reimbursement is available and the employee does not ask for reimbursement, normally the IRS has disallowed the deduction to the employee. An example was a salesman who underreported his travel expense to impress his employer, and the teacher who spent her own money on classroom supplies when the school budget was inadequate. This is a court case that may be at odds with other court cases. There may be other authority that allows a teacher to spend money for buying classroom supplies and getting a deduction for them as an employee business expense. Right now, Section 62A2D does allow up to $250 per year for the purchase of classroom supplies to school teachers as a adjustment to arrive at AGI, above the line deduction. So this code section is by itself infers that the remaining amounts, anything exceeding $250, may be allowable as itemized deductions. At the end, whatever is allowed to an employee as an employee business expense, as you know, is allowed only as a miscellaneous itemized deduction that is on Schedule A, subject to 2% AGI floor, and is added back as an AMT preference for alternative minimum tax purposes. There are some expenses that are clearly business expenses and they're deductible under Section 162. And there are some expenses that are clearly personal and are not deductible under Section 162. In the middle of these, there's a range of expenses that are not clearly either completely business or completely personal, but they have an element of each. And when this occurs, we need to make a decision how to treat this item, whether we treat it as a business expense, whether we treat it as a non-deductible personal expense, or whether we treat it as an item that is both and needs to be allocated between these two elements. Some expenses are inherently personal, and even if they have a business element to them, they're not deductible, such as daycare and business clothes for an employee. Some expenses are personal, but they increase because of the business activity. An example is an employee that has to transport his business tools on his commute to work. So for instance, he may be required to get a trailer to put the tools in to tote behind his car. The cost of his commute to work is not deductible, that's a personal item. But the additional cost of transporting his tools to work is a business item and needs to be segregated out of the total cost of commuting, and it's deductible. Another example of that would be if an employee had to get a phone line with fax or conferencing capabilities because it was required by his work. The incremental cost of the upgraded line would be deductible, but the normal cost for carrying a personal line for the home would not be deductible. So the phone bill would have to be divided into two portions. For some mixed expenses, this excess business portion can be directly measured. For example, the use of a home office where a portion of the home with a defined limit, square footage, is used for business only, or the use of a vehicle for business where the miles driven for business can be measured and distinguished from the miles driven for commuting and pleasure, and meals and entertainment where a business meal can be tracked and added up at the end of the year. So in this case, an allocation must be made between business and personal, making the measured amount of the business element of the expense deductible. For some expenses, the primary purpose is business, and any benefit derived from it is a mere byproduct. For example, in a domestic business travel, when you travel to New York for business, the cost of your transportation there, air transportation, the cost of the hotel, your meals, those are all business expenses. The fact that you may do some sightseeing while you're in travel status that has a personal element does not cast a shadow on your activity, and therefore, since the primary purpose of your activity is business, then all of this cost is a business expense and therefore deductible, subject to the specific limitations. For example, the meals incurred on that business are still subject to Section 274 limitations and only 50% deductible. And of course, if you incur any personal expenses while you're in travel status, such as going to a movie, or the cost of your sightseeing activities and so forth, are still personal in nature and must be accounted for separately. Some common types of expenses that have both elements of personal and business are listed here on the slide. Food and shelter. As we know, food and shelter are personal items and they should almost never be deductible. However, there are circumstances where your business activities require incurring lodging or meals as expenses that have a business purpose to them. For that reason, lodging on a business trip is always deductible, with exceptions for certain foreign travel. So, lodging, even though it's a personal living expense, it's an additional expense that's being incurred while you're on a business trip, and it is deductible. Business meals are partially deductible under Section 274, and there's a 50% disallowance automatically applied to them. There are two main ideas behind this disallowance. First of all, a meal, regardless of how important it is in a business meeting, still has a personal element to it. And secondly, it's really hard to document the extent to which a meal serves a business purpose. In other words, it's hard for a businessman to prove that he could not have conducted the business meeting that he conducted over a few drinks with a customer or with a meal with a potential client. So for that reason, if all the other documentation requirements under Section 274 are met, the code allows the deduction for business meals and entertainment type expenses, but it subjects them to a 50% discount. Clothing, again, is a personal item, should not be deductible, and almost never is deductible. The exception that is made by the IRS for uniforms. They are deductible only if they are specifically required as a condition of employment, and they cannot be altered for ordinary wear. So it's not something the taxpayer could ever use anywhere outside of the work environment, as outside of his or her business. And ordinary business attire, suits, watches, jewelry, grooming, hairstyling, cosmetics, these are personal items that are almost never deductible, even if they're required by the employer, except in certain limited circumstances where an exception is made for entertainers and performers, where their business activities is entirely dependent on their appearance. Here are some more types of mixed business and personal expenses. Commuting, getting to and from work from home is always a personal expense, not deductible. This is established by judicial authority that established that an employee is in the business of being an employee and chooses to live away from his or her work, and therefore must bear the expense of getting to and from work on his or her own. That's not a business expense. However, exceptions to that is when an employee commutes or travels to a temporary job site, that is deductible, and the expenses of commuting between two job sites is deductible. We will expand on this more in a later chapter when we talk about business expenses, and there are more details to these exceptions that are listed here, and there are additional exceptions that may be available for commuting and business travel between the employee's job sites, between the employee's home and customer sites. If you want to get all the details on this subject, please refer to Revenue Ruling 90-23. These rules are explained thoroughly in that revenue ruling. With respect to litigation expenses, these expenses must overcome a dual obstacle to be deductible. First of all, they must be business type expenses arising out of taxpayers' business, defending against charges that are allegations with respect to taxpayers' business, bankruptcy with respect to business debts, defending the taxpayer's business reputation, and so forth. Secondly, they must not be capital expenditures in nature. So the cost of defending, for example, a title to a patent or any other property is actually cost of that property must be capitalized to the property and not deducted. Expenses of maintaining a public office are deductible as business expenses under a specific code provision, 7701A26. So the code gives a benefit to litigators and public officials by allowing them to deduct expenses as business expenses that are normally deductible only as employee business expenses to other people, even if they're allowed at all. However, expenses of political campaign are never deductible. And finally, a collateral rule, very important rule, is that the reimbursement for employee business expenses are excluded from income to the extent that the expenses would have been deductible if they were unreimbursed. Under Section 162 or 212, an expense simply being incurred in the context of a taxpayer's trade or business or profit-oriented activities is not enough to make it deductible. It must also be an ordinary and necessary expense. So beyond that, this discussion becomes somewhat philosophical, because it's hard to imagine that a businessman would incur a business expense if he didn't feel that it was ordinary or necessary, and especially if it was not necessary. That the profit motive itself would dictate that the expense wouldn't be made in the business. If we look to the court cases, Welch versus Halvering, the Supreme Court said ordinary has a connotation of being a normal, usual, or customary expense, an expense that may be ordinary though it happens but once in the taxpayer's lifetime, yet the transaction must be of common or frequent occurrence in the type of business involved. And necessary, again from Welch versus Halvering, is it's not simply enough the taxpayer incur an expense in his trade or business or profit-oriented activities, but these expenses must also be ordinary and necessary. So beyond that, this discussion becomes a little bit philosophical, because it's hard to imagine a businessman making an expense in the context of his business if he doesn't believe that it's necessary, or if the expense wasn't an ordinary type of a business expense that occurs normally in the business world. Looking to the definitions for ordinary under Welch versus Halvering, the Supreme Court had ruled that ordinary does not mean habitual or normal in the sense the taxpayer will have to make them often. Rather, the payments have to be normal, common, and accepted under the circumstances by the business community. And in Deputy versus DuPont, the court stated that ordinary has a connotation of being normal, usual, or customary. An expense may be ordinary, though it happens but once in the taxpayer's lifetime. Yet the transaction must be of common or frequent occurrence in the type of business involved. Definition of necessary, again from Welch versus Halvering, the term necessary requires only that the expense be appropriate and helpful in developing the taxpayer's business, not that they are indispensable or unavoidable. So when you look to an expense to determine whether it's ordinary or necessary, keep these definitions in mind. Is it a usual business expense, and would a prudent businessman make those because they would think that they're helpful in developing their business and that they're appropriate? And that would weed out some expenses that may be bogus or flagrant and not made in the spirit of promoting one's business. From early times, the courts had established that a business or investment activity expense is not ordinary or necessary if it is capital in nature, and therefore it's not deductible. However, now that concept is not as relevant because there are code sections that disallow the deductions for expenditures that may be considered ordinary and necessary. However, because they're capital, even though there would be a deduction allowable for them under Section 162, under Code Sections 263 and 263A, the deduction may be deferred or disallowed because the item is capitalized. And as we mentioned before, personal expenses are generally not ordinary and necessary, and therefore, even if they were made in the context of business, or they appear to have been made in the context of a business, they're not allowable. An example is a tax lawyer who painted the magic number 1040 on a red, white, and blue pennant on his yacht and tried to deduct the cost of the yacht's maintenance and was not successful. As part of deciding whether an expense is ordinary or necessary, the courts have ruled that reasonableness of the amount incurred is also a consideration, even though the code itself does not require that the expense amount be reasonable per se, except with respect to compensation. However, the courts have ruled that in order to be determined to be ordinary, it must be reasonable in amount. And then another consideration is whether an expense is ordinary or not. And by that, the decision has to be made whether an item is an ordinary expense or an extraordinary item. And here you see some examples where the courts have said we cannot allow an expense here because to allow this would open the door for too many bizarre analogies, as Welch versus Halbring had stated. So a stock dealer purchasing life insurance on the life of the US president to protect the economy, well, that was not allowed. Hiring a minister for advice on a business problem, that was not allowed. Hush money paid by an attorney to silence an accuser, and kickbacks to a customer's purchasing agent. All of these, even though made in the context of a business, they were determined not to be ordinary and necessary expenses and were disallowed.